My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do my friends. I'm just trying to make little money. My job is not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Today we found out what's wrong with the drugstores. It's not the shoplifting. It's not the jury brick and mortar locations. It's not the maximum security prison of merchandise where you need to call the jailer to get a bar of soap. It's not even the often downtrodden employees who are tired of having to watch people walk out of the stores without paying. No, it's Amazon. On a day when the Dow gained 36 points, S&P inched up 0.09%, Nasdaq advanced 0.3%, I see Amazon hitting an all-time high, putting it in the rarefied air of the $2 trillion club. I see Walgreens hitting a multi-year low of $12, down 22% today. You know, after reporting an abysmal quarter, it was its worst day ever. We had our CNBC Investing Club meeting today, and we discussed the greatness of Amazon, but I feel we gave it short shrift. Amazon's so phenomenal that I think it can destroy pretty much any industry it chooses to go after. It's the retail Death Star. For example, just today we learned that Amazon's planning to launch a discount store to go after the ultra-low cost but often ultra-low quality of Temu and Shein, two online stores that source a great deal of product from China. These two outfits have arguably become the most powerful apparel makers in the world. Now that Amazon's rolling out a similar discount store to compete against them, I actually don't envy their prospects. But with Walgreens, all I can say is that Amazon taking no prisoners, TNP. First, I understand that Walgreens missed the estimates this morning by a mile, causing its stock to cascade back to its lowest level since 1997. That is a long time ago. The company revealed that it will close a significant number of money-losing stores. We don't have a firm number yet. Tim Wentworth, the newest CEO, didn't mince words on the conference call. Quote, the severity and duration of the challenges in the operating environment have only added urgency to our strategic and operational review, end quote. He went on to say, quote, we are at the point where the current pharmacy model is not sustainable, and challenges in our operating environment require we approach the market differently, end quote. No wonder the stock was down 22%. Now, Wentworth's ideas include putting some serious money behind the pharmacy side of the business, the back of the store, so to speak, because that business is still good. That doesn't mean opening clinics, as Walgreens has a stake in VillageMD, which they intend to monetize or unlock liquidity, although I do not know how they're going to do that. Remember, Walmart recently closed its 51 healthcare clinics in their stores because they couldn't make them work. Too costly, hard to staff. So who the heck's going to pay up for these properties? I don't have any idea. Maybe some private equity clown. There are a bunch of them out there. But let's deal with the reality of the situation. If you listened to the conference call today, and it was really just a tale of woe, frankly, you would have heard Tim Wentworth trying to make sense of the decline. You may not know that he is actually one of the finest business people in the world. Someone who turned around Express Scripts and then sold to Cigna for an immense profit for shareholders. He knows this business well. He's identified the edge that Walgreens has for the moment, the pharmacy in the back of the store. But as Walmart found out, pharmacists are also hard to find. Wentworth's been spending a lot of time talking to deans at 15 pharmacy schools, as well as talking to the trade association just to find some workers. It's vital. But how much will it even matter? It might be a foot race. Can they close enough weak stores, stop the pilferage, and hire enough pharmacists while they get out of bad leases and shrink the store so that it relies on its core competence of selling medicine? Will Rite Aid close enough stores, allowing Walgreens to get their best pharmacists? Or will Amazon simply eviscerate them like it did to the late lamented Borders or the shrinking Barnes & Noble bookstores? Here's the real Walgreens problem. For years and years, it relied on shoppers who bought all sorts of merchandise at standard prices, in part because they needed to get to the back of the store and pick up their drugs and then walk back to the register, and why not stop and get some Cheez-Its? They were terrific, almost captive customers who seemed more sensitive to time than price. We had two huge, beautiful stores of theirs within a block of our office. You had two. I know it sounds really stupid, but bear with me. I remember when the second one opened, it was a gorgeous store. It had everything. It had sushi. I had the sushi. It was okay sushi. We actually did a show from it with an old CEO of Walgreens. I remember asking the manager how it was possible how they could have two stores within a block of each other. The answer? Too much business to handle at one store. Now both stores are closed. Too little business. So what really happened here? For one thing, service went to hell. They fired as many people as they could while still keeping the lights on. But then they became ground zero for theft. So they put the best merchandise in plexiglass prisons, and now you have to call a clerk to open the gate. However, having fired a ton of workers, there aren't enough people to open the plexiglass lids. I once waited 5 minutes. I charted it on my phone. I pressed the button. I did all that stuff to see that it was really 5 minutes before I called management. Nothing happened. 5 minutes waiting for shaving cream, haplessly pushing some button while I stood by idly. I finally just left. It's a lesson in how to turn a Walgreens customer into, well, how about an Amazon customer? Think about it. You're an Amazon Prime subscriber. You get dressed in the morning for work. If you're running out of something, instead of taking some time during the day to go ring the buzzers and hope that some downtrodden Walgreens employees will be able to break away from what they were meaning to do and open your plastic doors, or you just order from Amazon. For the last few years, Amazon's been working endlessly to ensure same-day delivery for the stuff. Look, do you really care? Let's say you can't forget the shaving cream at 10:30 a.m. at the office or 10:30 a.m. at your home. You're not going to shave the next morning anyway. You don't shave intraday unless you're like Richard Nixon or something. The only difference is that Prime's cheaper. Oh, and it's not like he was the president of the United States. Oh, and it's not like they only have the basic and stripped-down razors and blades and shampoos and deodorants. Instead of the exotics, they're almost always under lock and key. No, Amazon has more varieties than Walgreens. They have like 42 different Old Spices instead of just the usual like 17 Old Spice. They got every Old Spice. How many new Old Spices came out today? Anybody haven't? Come back to me. Look, Amazon's never set out to destroy Borders. They didn't set out to destroy Walgreens either. But they do set out to get the best products with the best values at the most convenient places. Most convenient places meaning your home. Walgreens can't afford to have the lowest prices, and we never expected them to. Who would have thought their stores could be less convenient than Amazon? It's a wonder to behold. Now let's throw in one more issue. Watching people right in front of you steal what you're actually paying for. Now, I've seen this happen in Walgreens all over the country. I've seen people caught by police and then released on the spot. I was part of a San Francisco catch and release program. I'm not getting a police officer. He told me, he says, listen, first he asked me if I'm an angler. And then he said, listen, we do catch and release in San Francisco. See, here's an amazing thing. You have to pay when you shop at Amazon. It's a bummer. You got to press that button that says pay. I don't know. You pay. Sorry. Meanwhile, beyond the front of the store, Amazon's constantly trying to be your pharmacist. They offer a bunch of medicine. And, you can go to GLP-1. They got the Wegovy stuff. It's right there on the homepage, for heaven's sake. I think it'll be game over for the back of the store once we begin to speak to an AI version of our doctor pharmacist, which is, by the way, what they're working on. And that doctor is a lot more empathetic than your doctor. Trust me. Especially if you're the village, the village DM, what is it? What do they call that? The City MD Summit, whatever. And that's when the drugstore goes the way of the dodo bookstore. Here's the bottom line. The stock market can be a brutal taskmaster. So can capitalism. I'm sure that Walgreens will come up with some way to make money before its debt position wipes it out. But right now, my money's on the company with the stock that's on the all-time high list, not the one that's on the new low list. My money is on Amazon. I feel like taking calls. I feel like going to Betsy in California. Let's speak to Betsy. Betsy.
Yeah. Hey, Cramer, I got one that is on the low list, and I'm struggling with it because the PE is 8.9, the profit margin is 13.59, and the institution's at 75 or 77% in, depending on which chart you read. And yet, the raw materials are schlepped halfway across the country, and you need to process the raw materials into coke before you even can make the finished product.
Okay.
Kramer, tell me when can I invest in Nucor again? Because Leo is money good.
Okay. I think Nucor is the greatest manufacturer in America. I think the problem is that the estimates are going to prove to be too high because business is slowing. This is what the Fed's doing. And understand that we're not against the Fed because we don't want inflation. But Nucor right now is a casualty. And once the Fed starts cutting, you're going to be in that stock. Maybe you take some pain now, Betsy, and you'll get some gain later. And by the way, when she's speaking of coke, she's not even speaking of an illegal one or a liquid one. She's speaking about actually something that's made in a steel mill, okay? I got to qualify that because I don't want people to get the wrong opinion of anybody. All right, look, I'm sure Walgreens will find a way to make some money before its debt position wipes it out. But my money is on Amazon. It's the company that's hitting all-time highs rather than the ones that are hitting lows. So Mad Money tonight. Micron symbol MU fell out of earnings. It fell out of favor today because of a forecast. That's ridiculous. I think it's garden variety profit taking a red hot stock. Or maybe somebody else is there. Why don't we just talk to the CEO? Don't miss my exclusive. Then, is it time to raise a glass to Corning after the stock hit a 52-week high? I'm giving you my take and sharing if the glass remains half full on the story. And what did you make of AeroVironment here after the stock's major post-earnings slump? I'm getting the latest from the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, what the heck just happened to the stock of Micron? Last night, the commodity chip maker, and I don't really ever this list I'm ever going to call a commodity, by the way, reported what I thought was a pretty darn impressive set of numbers, yet the stock did get hurt, with closed down 7%. Micron reported a monster 14-cent earnings beat off a 48-cent basis. Its earnings per share up 48% from just the previous quarter. Sales were up 81.5%. Gross margin soared. Sounds pretty good, right? I certainly thought so, and most of the analysts agreed, but the stock got slammed anyway. So what gives? I saw people saying the problem was Micron's sales guidance for the current quarter, which was merely in line with the consensus estimates, not dramatically above expectations. That strikes me as a very bad reason to dump this stock. Really, I think it was just that Micron was due, okay? It's up 67% for the year. It's doubled since a year ago. That's what I think's going on. Don't take it from me. Let's check in with Sanjay Mehrotra. He's the president and CEO of Micron Technology, better sense of the quarter. Mr. Mehrotra, welcome back to Mad Money.
Jim, great to be back on your show today.
Oh, thank you, Sanjay. So let's just step back for a moment from the day-to-day trading. You have come up with some incredible chips. They're not commodity chips. They're incredibly proprietary. And you have a high bandwidth memory chip that's probably going to be the star of the next maybe 10, 15 years for AI. You are not given to hyperbole. There are people who want you to be hyperbolic. Is it not true that these chips could be, particularly high bandwidth memory, huge chips for many, many years because of AI?
Absolutely. We are in the very early innings of AI here. High bandwidth memory last year was in single-digit billions of revenue, low single-digit billions of revenue in our industry. And as we look ahead in 2025, high bandwidth memory is going to grow to over $20 billion of revenue. And Micron, in the very first quarter, in FQ3 that we just reported, we began shipping this product and already achieved $100 million of revenue. And we said in our fiscal 24, we will have several hundred millions of dollars of revenue and growing into multiple billions of dollars of revenue in our next fiscal year, which will start in September. And this product is already accretive. And Jim, what is exciting is that this is a highly complex product. Micron has the best product in the industry, 30% lower power than any other product. And you know that in AI applications, data center applications, performance is important. And of course, we have better performance with our product as well. So this product is critical to AI applications because this is what increases the pipe for the communication between the GPUs and the memory. And that's with data-intensive workloads, that's very important. That's what enables, ultimately, AI applications. It enables generative AI. So yes, we are in the early innings. I think we have a long road ahead of exciting opportunities. This is HBM3E in 2026 timeframe. There will be HBM4 and follow-on generations of HBM4E. So exciting roadmap ahead, and we are very much focused on it and excited about the opportunities, and Micron team is very much focused on execution here.
Okay, some people know the Micron, say, from the 90s and the early part of this century, and then the last even 10 years, that it's boom, bust, boom, bust. But the product you just described is not a commodity. It is a secular growth chip that people aren't used to seeing Micron do, and therefore I think they don't understand that you are not going to sit here and say that it's going to be huge, although we don't know what's going to happen after. That's not the trajectory of this HBM.
HBM enables tremendous opportunities for differentiation. It enables opportunities for differentiation. The future generations of HBM that I mentioned, like HBM4, actually enable processor and memory to come together to even drive greater innovation, faster performance at the compute platforms, at the accelerator levels in terms of interface with the GPUs. And important thing also is that HBM is the kind of memory that takes 3 times more silicon to produce the same number of bits. So as HBM grows in penetration in the DRAM market, and of course it will scale up as AI gets bigger, it actually is a headwind to the supply growth in the industry. So HBM is really a great margin accretive product for not only by itself, but it actually has an impact, the ripple impact on the pricing increases through the rest of the DRAM industry as well, because of this supply impact that it has.
At the same time,
this is a great product. An important thing, Jim, is that of course HBM is a great product for AI, but AI is permeating through edge devices as well. PCs and smartphones, where Micron is well positioned, are also, enabling AI, and they require more memory content in those devices as well. And this is why, Jim, we say that Micron will be one of the biggest beneficiaries of growth enabled by AI in the semiconductor industry, because our exposure to AI growth goes from data center to edge devices such as smartphone and PCs and automobiles. So really, I don't think besides NVIDIA, any other company has as large exposure to the AI growth as Micron does in semiconductor industry.
I want people to know your history. You came on, you told me back in literally a year ago that, look, inventories, which had been very bloated, and I many times had said, please give me the go-ahead, the inventory. You said, no, Jim, the inventories are elevated. Inventories were no longer elevated last summer. You said that. That's when the stock was in the 60s. And that was money good. And everybody who listened caught a double, who listened to you. I am hearing you now say, listen, and I know that these products are harder, so you don't get the yield immediately, that you are not saying that, look, we are in the 6th or 8th inning. You're saying we are early because this is a different kind of chip for Micron.
Absolutely. AI is in early innings. Generative AI is in early innings. High bandwidth memory is absolutely in early innings. And it is really a generational product, totally transformative kind of product for our industry. But again, it's not just HBM. Micron has products, high density DIMMs, which will be several $100 million in our second half of this fiscal year for us, as well as low power DRAMs, which also go in data center servers. And of course, we have a strong portfolio of products that go into smartphones and PCs and automobiles, and of course, solid state drives.
Right.
Our enterprise SSD drives actually hit a record for us in our FQ3 that we reported, again, driven by growth of AI.
Well, I've also
so we talked about it in our earnings call yesterday, Jim, that our data center revenue mix this year will be a record level, and it will grow from here on in fiscal year 2025 as well. So we are absolutely playing along the strategy that we defined a while ago to continue to shift the mix of our products toward higher margin solutions, and data center is an important piece of that.
At the same time, I was trying endlessly to say, listen, can I call an end to the PC cycle? And you said, no, and that too was dead right. But now with AI in the PC, I hear you saying that things could be quite good.
Things have largely played out as we said before, yes. Jim. We had said data center inventories will normalize by midsummer. They have normalized, and you are seeing a strong buying pattern for memory in data center. We had also said some time ago that because of increasing prices of memory, as well as tightening supply that our customers were seeing with memory shifting more and more toward data center, and of course their AI PCs and AI smartphones coming online in the second half of the decade, some customers in PC and smartphone markets built some inventory, but this is really to address their demands. And as we look at 2025, AI will drive growth in PC and smartphone as well. PC is going to have refresh with 2012 Windows, Windows 12, as well as expiration of Windows 10 and new AI PCs is going to drive a new replacement cycle.
Many drivers.
We are positive on PC and smartphone and well positioned to address growth there as well.
And I want people at home to understand, he did not say that because he is hyperbolic. Sanjay, and he's right here, so I feel a little awkward saying it behind his back in front of him, is conservative. And that's one of the reasons why people sold down the stock. And don't ever say, I'm going to sell a stock because someone gave conservative guidance when they've been right about their guidance the whole way, and that in the sense that they did not put any hype into the numbers. Sanjay Mehrotra, thank you for coming on Mad Money. I think you really told us the way people should understand. Great to see you.
Thank you, Jim.
No hype, just great numbers. Mad Money's back after the break.
Coming up, in case of profits, break glass, a stock screen about a stock that helps make screens. Next.
Look, I'm always watching the 52-week high list, searching for new ideas. For the past few weeks, you know what? It's become impossible to ignore Corning, which used to be an incredible performer many years ago, but it's been absent from the new high list for ages. Corning makes specially engineered glass, ceramics, and plastic products. Think the glass used in fiber optics or for flat panel displays, not to mention all sorts of car and truck components. This stock was a huge winner before the dot-com bust. Then from 2002 through early 2021, it gradually worked its way higher. Again, though, in fits and spurts, it's been a hard stock to own. See, the problem is, there was a ton of pull-forward demand in Corning's end markets during the pandemic. Everything from electronics to autos to semiconductors to lab equipment. That pushed their earnings to record levels. They over-earned, though, because when we got over COVID, Corning got hit with a serious slowdown because we already had enough hardware and fiber optic infrastructure. We didn't need any more from Corning. And that's why the stock fell 46% from its highs in 2021 to its lows last October. Now, for the last 8 months, though, Corning's really been on a roll. Now, first, there wasn't much to justify the rally. These guys reported a hideous quarter last October, and then had slightly better numbers, but still gave a weak outlook when they reported again in January. And you can see, look where the stock, okay? Get a good look at it. Finally, 2 months ago, we saw what the buyers were anticipating. When Corning reported a strong quarter, the stock jumped 5% in response. Since then, it's kept running, hitting $40 and change last Friday, its highest level since early 2022. Although after a nasty pullback yesterday, it's back to $38 and change. So what's driving this unexpected comeback? And boy, is it ever unexpected. More importantly, can Corning keep running? Okay, let's start with the numbers they posted at the end of April. While this was by no means a blowout quarter, it was a solid set of numbers with management giving us an optimistic outlook for better days ahead. That's all they needed to do, given how awful the previous 2 quarters had been. When you look at Corning's 6 individual segments in the 4 largest optical communications, display technologies, specialty materials, and environmental technologies all came in stronger than expected. Only the 2 smallest divisions came in weak. Most importantly, right at the beginning of the conference call, Corning Chairman and CEO Wendell Weeks ticked through the high-level financial highlights of the quarter and then said the magic words, quote, "We're seeing encouraging signs of improving market conditions. We continue to expect that the first quarter will be the low quarter for the year," end quote, bing, say no more. Corning believes that the first quarter will be the low and business will build from there. That claim got some extra credibility because management also offered better than expected core sales guidance for the current quarter, as well as inline core earnings per share outlook. Now, the company's got a 3-point framework for higher earnings. The first point being that sales have already bottomed. I like that. Second, management plans to grow its sales by $3 billion in the next 3 years. That's a substantial sum for a company with $13.6 billion in revenues last year. More on that later. The third and final step, Corning's in an industry with high fixed costs and relatively low variable costs. They've got all these expensive factories that aren't running at full capacity. So when they get a huge sales boost, most of that new money flows right through to the bottom line. Corning actually introduced this 3-step framework for higher earnings back in January, but nobody cared at the time because management also hit us with lowball guidance for the next quarter. It was like the company was saying, look, the first quarter will be bad and then it'll get better from there, trust us. Not many were willing to give them the benefit of the doubt until we saw that things were playing out as predicted when they reported again at the end of April. Still, it's easy to say you can grow sales by $3 billion over the course of the next 3 years. It's much harder to deliver on that promise. Corning's got some exciting stuff planned, talking about 85-inch TVs, automotive glass that supports autonomous vehicles, products for solar energy, and innovative pharmaceutical packaging. But there's one product category that's far and away the most important, and here it goes: optical communications equipment. Talking AI. See, alongside glass for various flat screen displays, optical is Corning's largest segment. Unfortunately, it's also been one of the last parts of the business to find a bottom and begin turning around. That's primarily because the top customers here and telco carriers, after years of investing to build out their 5G networks, many of these outfits have been dialing back their capital spending plans. That's done serious damage to Corning's optical business, which saw its sales shrink by 20% last year. Even in the first quarter of this year, optical sales were down 17%. However, I think this division is already turning. For Corning, their first quarter optical sales were up 3% from the previous quarter, and that 3% sales bump translated into a 14% increase in net income. Remember, when the sales go up, the earnings explode here. On the latest conference call, management said that the process of telco customers working through their inventory and ordering new products was well underway. But I'm more interested in the new growth drivers for Corning's optical division. First, we've got federally backed programs to expand broadband access for rural communities, including the $42.5 billion Broadband Equity Access and Deployment, or BEAD, program. That's practically a subsidy for Corning's fiber business, and the money should start kicking in next year. Second, and more important, you know what else needs fiber optic equipment? Data centers, especially the ones being used for artificial intelligence. These new data centers that are being built, being purpose-built for AI, require a ton of fiber. A lot more fiber in order to connect their NVIDIA chips into super powerful GPU clusters. Corning's going to win a ton of this business. Corning's also coming up with entirely new products for these modern AI data centers, including something called the Rocket Ribbon Cable, which reduces cable diameter by 60%. That matters because smaller, denser cables are ideal for AI infrastructure. When you're dealing with tech, smaller is always better. Putting it all together in Corning increasingly feels like a stealth play on the hottest trend in the world, doesn't it? People started to notice. Late last month, JP Morgan upgraded the stock to overweight, saying, and I'm going to quote here, cyclical and secular drivers in the primary business of display and optical are lining up favorably for the company and should position it well to leverage the upcycle in revenue, end quote. I could not agree more. Look at this, will you? While the stock's already up 53% from its October lows, it still sells for just over 20 times this year's earnings estimate and 17.5 times next year's earnings estimate. This is assuming the estimates are too low, frankly. Here's the bottom line of this, what I think is a very exciting story to me for the first time since 2000. 1999, actually. If you believe in the turnaround here, then Corning's going to have a lot more room to run. And me, well, just call me a believer. Let's take some calls. Let's go to Trey in Texas. Trey.
Jim, I drive a hearse for a living, and I can tell you there's one thing we last responders know better than anyone else, and it's that life is short. Therefore, I must escape the rat race. Something about being a 45-year-old man asking permission to take a vacation doesn't sit right with me. Jim, I need a retire early stock. I'm thinking it may be AI and cybersecurity champ Datadog. What are your thoughts?
Look, I happen to think Datadog is an incredibly good company. I wasn't totally enamored of the last quarter, but it's certainly better than some of the others like MongoDB. I'll do this. I will tell you that I don't think this Datadog is going to be an NVIDIA. I don't. But I do agree with you that I think it can trade higher, and it's a very well-run company. I wish that Olivier would come on because it's a great story. All right, look, if you believe in Corning's turnaround plans, then the stock is going to have a lot more room to run. It's a really accessible, good, great American company. Count me as a believer. Much more mad money at. AeroVironment stock is sinking on earnings, but could potential geopolitical threats make the company a compelling play? I'm going to talk to the CEO. Then, should you really be selling Levi's all the way down here after last night's report? I have a message for the sellers in this legacy denim company. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. All right, look at this decline in AeroVironment, the defense contractor best known for its high-tech drones, ground robots, all this stuff that represents the future of the way warfighters are going to do their job. Last night, AeroVironment reported a solid set of results, gave what people thought was muted guidance for the full year, and it crushed the stock. I mean, sent it down more than 50% at its lows, although ultimately it rebounded as cooler heads prevailed. How about that? Does it make sense to abandon this one after maybe a weaker forecast? I am a huge believer in this business, in this company. Everybody who's watched this show for any long time knows that I like this thing way, I don't know, maybe it's probably going up more than 4 times from when we first started talking about it. So let's take a closer look right now with Wahid Nawabi, and he is the chairman, president, and CEO of AeroVironment. Wahid, welcome back to Mad Money. It's great to have you.
Great to be with you, Jim.
Okay, so I'm proud to have been with you for a long time because we felt that you offered the alternative to these big, heavy systems, which to me seem very outmoded because you have to have ground war fighters be able to shoot and live and have people have it up in the sky. All that I've seen so far that I'm most proud of you about is this. Well, there's been many things, but you were the first one in this replicator program, which to me is the Pentagon saying, listen, we're not tolerating the expensive stuff anymore. We want precision, and we want it done without a huge amount to the taxpayers. Tell us about the win.
Jim, you called it right 4 or 5 years ago when our stock was in the 20s and 30s, and where we are today, it's fantastic. And of course, we are just starting.
Right.
The fundamental shift in warfare is that distributed intelligent robotic systems, loitering munitions, small drones, that's what we specialize in, right, is going to be a much bigger piece of the warfare in the future. Conflicts in Ukraine, conflicts in the Pacific, it's all with that. Replicator is the first initiative that the Department of Defense has taken up to the Undersecretary, the Deputy Secretary of Defense, right, Kathleen Hicks. Dr. Hicks has actually made it a mission to bring in these types of capabilities to be able to deter China and also defeat our adversaries in that theater. And we were honored to be selected as the first awardee for the replicator program, the Switchblade 600. And the Army said that they're going to buy over 1,000 of those immediately on the first tranche of the replicator initiative. And we're ready.
Right. Now, people have to understand that you, early on, I know, because we met and we talked about agricultural drones, because the government, frankly, the military, was not as ahead as what you saw would happen. You predicted all of this. Unfortunately, we have real wars going on, but you predicted that Taiwan would have to be protected. You predicted that Russia could be a problem. Now, Ukraine and Taiwan are gigantic markets for you.
That's right. Absolutely. So Ukraine today, to date, we've delivered thousands of units of our robotic systems. 9 of our different products, 9 of them are in use in Ukraine. We are the workhorse of Ukraine as an air force. The Pumas and Puma LEs are flying all over. Almost every artillery that U.S. DoD has given to Ukraine has a Puma flying in front of it to try to find targets, assess the battle space, find targets and sweeten the targets for them so they're more effective. You know, having a HIMAR even, fire without the knowledge and intelligence and surveillance of a Puma, it's less effective. But the Puma makes it a lot more effective. So we want to increase the efficacy of these systems that we're providing to Ukraine. And Taiwan is going to be very similar. And we're the only company that I know of that can actually produce these things in thousands of units at the DoD quality and rigor today.
And we should talk about that. I remember when Ukraine were first talking about funding Ukraine, and there were a lot of pictures about the Javelin, and the Javelin's not yours. And when you looked into the Javelin, it was very expensive, and it also seemed like you had to see the target, which therefore almost always means the target can see you, which means that the losses, the number of men and women who were killed is way too high. What's the difference between your uncrewed and the Javelin?
So our Switchblade 600 has essentially the same warhead as a Javelin. It's an anti-main battle tank warhead that can go through any type of armored vehicle, and including the Russian tanks. Javelin is a line of sight. You have to physically be able to see the target, as you said, within 2 to 4 kilometers. That is a very close fight. It's way too risky for the warfighter to be that close. We do not want our men and women in uniform to be that close to the actual enemy. Our solution, Switchblade 600, could be shot from almost 90 kilometers away. Typically 40 plus kilometers, and once you get to the target, you could also loiter for about 40 more minutes to find the target.
Explain what loiter is, because I know that's a very important term. It's a term of art in your business, but people might think just kind of hanging out. What does loiter mean?
So loiter means that you have a very sophisticated gimbal or sensor in the front of the UAV or drone that actually looks in the landscape and finds the target. You're going to look around to see if I can find a Russian asset that's worth taking out. A tank, a radar system, a compound, a forward operating base, a munition depot, et cetera, et cetera. Once you find it, then you designate the target to the Switchblade, and then the Switchblade then goes and actually hits the target as an explosive munition. And so that's when it actually achieves the lethality piece at the end game of the actual hitting. So once you get to the site, which is 40 kilometers plus away, Then you have another 40 minutes to keep looking, to find the right target you want to engage.
Okay.
And then you take it out.
Okay, now a lot of people say, well, Iran's got these $500 things, and they're every bit as good as what you're doing. Could you please explain to us what the bad guys have versus what we have?
The best way to describe it is that American innovation, including ours, is by far the best in the world. Okay. There's nothing that our adversaries produce that is at the caliber that we make in the United States. This is a tremendous strategic advantage for the United States, and we need to keep that up. This is the reason why I invest 11 to 12% of our revenue in R&D, and this year we're going to say we're going to do 12 to 13%.
People don't like that you're spending so much on R&D. I do, because we know men and women in our armed forces deserve it. Now, let me ask you. Yeah. There is a presidential election tonight. I understand from what the replicated program is the current administration is trying to say you are the hope because you're not going to break the bank. Do you think either presidential candidate has a different view on drones, on what you're doing?
Not to my knowledge. Right now, both houses of Congress, both political parties are both the Pentagon leaders, everyone actually believes in this future because it is the future of what's going to be a much, much more wars of drones. The Ukraine conflict proved it to us. We will not fight.
You predicted it. You came on the show, and I was saying, when are they going to start ordering? I actually talked about ordering them myself and trying to send them over there. You told me you're not allowed to do that because you had them on the whole time. You said it, and I couldn't believe that we were spending millions and millions and millions and getting almost no bang for the buck. But you've changed that.
We have definitely changed that, and we've actually proven it in real life when our systems arrived, and now they're very, very effective in the battlefield.
They sure are.
And Ukrainians love them, and it's actually doing a lot of good.
And I hope you save Taiwan, because we cannot put soldiers there for some reason, but we can at least put drones there.
We are ready to defend and provide these systems in tens of thousands.
Perfect. That's what I wanted to hear. That's why Nawabi, Chairman, President, CEO of AeroVironment. I wish I'd been able to come on midday when the stock was down gigantically. That was ridiculous. Mad Money's back after the break. Thank you.
Thank you, Jim.
Yeah.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's time for the lightning round. Quick answer. You say to the start, set about myself down. The close talk, everything. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. I'm going to start with Brandon in New Jersey. Brandon.
New Jersey, booyah, Jim.
Right back at you, Garden Stater. What's happening?
Hey, I was looking at a stock you mentioned a couple months ago, Palantir. It's up 52% year to date and 20% month over month. At this point, is it too late to get in?
Well, if they would tell you what they do, no. That would help. I mean, a lot of things I tried to look at, it's one big giant black box except for the consumer product goods companies. So I'm going to have to say there's other people better to ask. Let's go to Brian in Nevada. Brian.
Booyah, Jim. How you doing today?
I am doing well. How are you?
I'm good. My question is about a stock that I've been accumulating for over 3 years now. They have a top-notch leadership team, including a CEO that receives no pay or compensation. They're staged for economic uncertainty and investment opportunities of over $4 billion cash on hand. What is your honest opinion on GameStop?
Okay, GameStop raised enough money off the backs of the apes, the memes, the kitties, whatever, that they can reinvent the company. If they reinvent the company, then you're absolutely right. They have such a big war chest, they can just close all the bad GameStops, and you know what? They can open nationwide ice cream parlors. Ben in New Jersey. Ben.
Thanks for all you do, and great club meeting today. I need your help.
Thank you.
Recursion.
Yeah.
What do you think of this secondary offering? Is the CEO
I didn't
reliable?
like the secondary offering. I thought the secondary offering, they priced it at 6.5. Were they desperate? I've seen them on there come on the show. Like, so that's an act of desperation. Don't do desperate things. Desperate things do desperate things to stock. I don't like desperation. Let's eliminate desperation. Let's go to Richard in Florida. Richard.
Hey, exactly. Mr. Cramer, thanks for taking my call.
Of course. What's up?
I just wanted to get your thoughts on IonQ.
Yeah, see, now this is a company that if it were actually to make money, I would start liking. Let's go to Ray in Maryland. Ray.
Hey, Jim, how you doing? It's Ray from Baltimore.
Hey, Ray, what's going on, man? What's happening?
I wanted to call to say thank you so much for what you've done for me over the years. I really enjoy the show, but as much as I enjoy the show, I think I like your books even more.
Oh, thank you. There might be another one in the works, but I don't want to jump the gun there. Let's take no prisoners. What do we have?
My question is about Marvell. I've owned it for a couple of years and I've done well, but in the last few months, it's been plateauing. Should I continue to hold?
Yeah, look, Matt Murphy has a division that's unbelievable and another division that's not. The unbelievable division continues to be unbelievable. The not so might get better, so therefore you should hold on to it. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Wait a minute. Should you really be dumping the stock of Levi Strauss & Company down more than 15% as it was today because the company failed to meet very high expectations when it reported last night? I think not. Last night on this show, Michelle Goss, the CEO of Levi's, delivered a quarter with light sales but a huge earnings beat. It wasn't enough because Levi's sells denim, and there's nothing hotter than denim right now. So people expected a sales blowout. Now, there's no denying that when a retailer doesn't blow out the sales, it won't necessarily be able to make it up on margins, even if Levi's pulled it off this time. But did the stock really deserve to get whacked that badly? I look at these situations and I recognize that the quarter had real issues. If you have a Beyonce Levi Strauss song on top of the hottest trend in apparel, this should have been Levi's moment. But the company's undergoing a difficult transition, trying to be more direct to consumer and less wholesale, where they aren't in control of their own destiny. These transitions are never easy. And it's got this Dockers division that disappointed and hurt the quarter. But what happens after the direct to consumer pivot? What if they just decide to get rid of Dockers the way, say, that Ralph Lauren sold Club Monaco? What if the guidance, which hurt so badly, turns out to be conservative? After all, the company did raise its dividend by 8%, which is a major sign of confidence. I think all of this has come into play before you sell something based mostly on the forecast and the incredibly high estimates that were almost impossible to meet. You have to believe that nothing can go right going forward if you're going to sell Levi's down more than 15%. I think that's a sucker's bet, especially because this is the best denim cycle I have ever seen, and I have seen a bunch of them. Don't abandon the best of breed in this early stages of this kind of cycle. We often see stocks that should go higher on earnings, but they get reined in by management trying to be prudent. Sadly, Wall Street's rarely a big fan of prudence. For example, I think Sanjay Mehrotra, the CEO of Micron, whom you heard earlier today, he kept his guidance lower because it could be, well, I don't know, there's absolutely nothing in it for him to get all bulled up about a given story. Anyone who's followed Sanjay knows that he's a cautious executive. He's not given to hyperbole. He did flag at the bottom last fall that inventories had gotten too lean. That was very good. But he didn't ring a bell saying it's time to buy. He didn't beat his chest to make a cold shot that this is the moment to buy Micron. It's almost as if sellers want him to stake out an outrageous position for no reason other than to help get traders out of its stock at higher prices. Sanjay's not trying to appease or make money for traders. He's running a business. Look, I know people take guidance as gospel. That's why both stocks got whacked. But every time I see this kind of sell-off of guidance, I hark back to another time on Mad Money when I was interviewing the legendary Frank Slootman, an amazing business person who was known for crushing the numbers. At that point, he was at Snowflake. He had just delivered still one more terrific quarter, but he gave us guidance below expectations that did send the stock cascading lower in after-hours trading. It was shortly before I started interviewing. I prefaced my question by saying I had to get at the big decline in the stock triggered by a very soft forecast, because that was indeed the skunk at the garden party. He gave me an answer I'll never forget. He said, Jim, the guidance is the guidance. In other words, he had to pick some number, so he did. It wasn't enough. So what? It didn't matter. He didn't want me to take me or anyone else to take the stupid numbers seriously. So my message to you sellers is simple. If you're dumping these stocks because of what's happened next based on management's comments about the future, let me just say something you should never forget. The guidance is the guidance. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here, my buddy. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.